All right, so we'll go ahead and get started. I wanted to do a couple things. First off, it's been a while since we've had a couple of these meetings, and I wanted to have just kind of a periodic, whenever the market kind of bounces around, just jump on and answer people's questions that may be coming up, and kind of give an idea as to what we're seeing as far as the market goes. As far as stocks are concerned, as far as interest rates are concerned, and we'll kind of cover that here in a minute. Before we begin, I wanted to kind of introduce a couple of different things, kind of a rollout of sorts. We're going to do, we have a couple of new software programs that we're going to implement and utilize for our clients. One is a company called Riskalyze. They're made by Nitrogen. Nitrogen Wealth is the parent company. They have a software program called Riskalyze that helps us to identify and maybe clarify more directly what the risk associated with each individual client's risk levels are. Over the last month or so, maybe 2 months, we've had a couple of situations where some clients wanted to get more aggressive, and we were being a little bit more conservative, and so we wanted to kind of have a situation or have a program to where we can kind of feel that we're a little bit more in sync with what clients' risk levels are so that we can invest accordingly. And so that's kind of what the idea of rolling this out is. And we're going to send out invitations, over the course of the next week or so. It'll come basically it's just a questionnaire that allows us to kind of maybe better formulate kind of what our client, the risk levels of each different client is, and make sure that I feel like we have a pretty good idea of what everybody's risk levels are, but in order to put it into numerical form, it helps us to make sure that the investments that we have synchronize with what each person's risk level is, and we're not taking too little risk for those who want to take a lot, and we're not taking too much risk for those who don't want to take very much. So we will be sending out invitations or questionnaires to all of our clients over the course of this coming week. And if you would please it takes 5 minutes just to kind of answer some of the questions. That comes back to us as a score or a number between 1 and 100, 100 being one very aggressive, one being very conservative. And that helps us when we compare the investments that we have in each client's account, making sure that it is synchronized with what their risk level is. And so that, again, that's coming out in the next or in the next week. We're going to do that. Also, as I mentioned in the email that I sent out to everybody, we're going to be doing more video chats. In many cases, it's just going to be us creating the videos and sending them out to you. Some of it's going to be on market updates. Some of it's going to be on changes that have occurred in IRAs as far as required distributions are concerned, or as far as inheriting IRAs, Roth IRAs. We'll talk more about some of that as things change. We'll talk more about Social Security. They're going to be kind of like more educational type programs that we'll be able to broadcast to you, and you can just look at it at your convenience. And again, hopefully, it will be additive to you as kind of, maybe something that may arise in your financial situation, whether it be a Social Security, because I do have a lot of times people say, "Hey, when's a good time for me to, should I take Social Security or not?" And that's where we have uh, you know, different uh, different learning courses that will help hopefully answer those questions. And so that's also something that we're initiatives that we're going to do. And then the next up, we're going to do some financial planning and tax planning as well. And this is financial planning. If you have kids, grandkids, relatives who might have questions about, how much money should we be putting away for retirement? Can I afford to retire? I'm already retired, but should I be moving money into a Roth IRA? Taxes, how can I better, plan for my tax situations going forward. So we'll have different financial planning software, and that we're going to utilize as well, that will help us to provide better services to our clients and help them answer questions. Education funding. If you've got a child or a grandchild who you want to put money away for a college, how much money should you be putting it away? Stuff like that, we can help answer those questions. So we're going to kind of be adding a lot more of that focus going forward as well, in addition to the management of the assets and other things. So that's kind of just kind of giving you a heads up on what's coming. And when we moved away from Raymond James, it allowed us to do a lot more in terms of communications to our clients. There was a tax software that I was using for clients 3 years ago. I started using. I think I got maybe one or two people that I was able to contact. It was a tax planning software by Holistiplan. Well, Raymond James wouldn't let me use that after I'd already subscribed to the subscription. So with the change away from Raymond James and more into Schwab, we have the ability to be a lot more available in terms of how the services we can provide and offer to you, and as well as the communications that we provide, and the educational software, or the educational programs that we're going to provide as well. So anyway, and again, a lot of that we're going to record and we'll be able to distribute to you as that happens in the future. But that's just something that's coming over the next 6 to 12 months. We're going to gradually implement that into our practice. So that's kind of the current events announcements to start with. Let me talk about the market, kind of what we're seeing, and what the expectation is going forward. So the Federal Reserve meets. The Federal Reserve of course, has raised interest rates over the course of 2023 for the most part, and part, well, really part of 2022 as well. And so the rates have been increasing over that period of time. The objective for that was to try and stave off inflation, to try and, as prices go up, they're trying to reduce our buying, or our power to go out and buy. If it's more costly for somebody to buy an automobile because the interest rates on a car loan are 6 or 6.5 or 7, at that rate, people will be less likely to go out and buy the car. Or the same thing about the refrigerator, or they'll buy the house. Right now 30-year mortgages are over 7%, and so we've seen a pretty drastic slowdown in home sales as a result. So the Fed raised interest rates to try and stave off that inflation. I don't know that they necessarily were successful, because insurance rates have gone up significantly, food prices have gone up significantly. A lot of the services that we have, if you go to the restaurants, it's gone up significantly. So they've tried to reduce or stave off inflation. I think they didn't get all of it, because clearly we had inflation, but I think now inflation is starting to peak, and we're really starting to see the impact or the effects of the rate increases that took place over the last 18 to 24 months. So now we're starting to see the economy slow down. The Fed meets next Wednesday, Tuesday and Wednesday. Next Wednesday, they're expected to announce that they're going to actually start cutting interest rates, probably by 1/4%, with the objective that they're trying to now thread the needle as the economy has grown and prices have gone up, inflation's gone up. Now it's starting to subside, and in some cases we're starting to see weakening. And so now the Fed's going to reverse the action of what they did previously, and they're going to now start cutting rates to try and stave off a recession, because that's the next concern: is now are we going to see a recession? So the economy is weakening. The GDP growth is slowed down significantly. Job creation has slowed down considerably. In fact, in March of 2024, the Labor Department came in and revised the growth of job creation for the year ended March of 2024. They reduced it by 818,000 jobs. So clearly, the information we got that said that we had, I think it was 2.7 million jobs created during that time. Well, they've tweaked it and revised it, and they reduced that number by 800,000. And so, in fact, we're seeing more and more of this going forward, is that as each month they announce the new jobs created from the previous month, they're retweaking and reworking the number that was announced the month prior to that and months prior to that. So we are starting to see a slowdown in the labor force. Retail sales are moderating. You're starting to see sales now. The buy one get one half price type sales at some of the retail outlets are starting to come back again, which is an indication that maybe things are starting to slow down in terms of retail sales as retail sales are concerned. As I mentioned earlier, housing prices have slowed down. Slowed down. We're seeing a lot more inventory on the market than we have in the past, and so you're seeing just basically we're seeing across the board, we're seeing signs that the economy is slowing down. Gas prices, the price at the pump now is, I think, I saw 255 or 257 over here. So we are seeing things starting to slow down, and I think the main concern now, as we're seeing the economy starting to roll over and weaken, the big concern is, are we going to run into a recession? And that's why the Fed's going to start cutting interest rates. I don't know that they're going to necessarily come out of the gate hot in terms of cutting rates, meaning I think they may only go a quarter of a percent. I don't think they're going to go a half or three-quarters of a percent like they have especially when we started off with COVID and they shut it down. They started cutting interest rates significantly, like a half a percent to three-quarters of a percent at a time back then. We're not in an environment now where they can afford to do that. I think they're probably going to cut a quarter of a percent just to kind of start to ease things a little bit. But as time goes along, we may see more successive rate cuts, in October, November, December timeframe, to continue to try and offset this recessionary environment. And I think for this, as far as stocks are concerned in the stock market, I think that's the biggest concern that we have is a recession. As the economy starts to slow down, we are seeing earnings starting to weaken from a lot of companies, and I'm telling you, if you are a company who did not meet earnings expectations, you're getting hammered. Nike last quarter missed earnings expectations. They were down 10 or 12% in a day, and Starbucks was the same way. There's a whole host of different companies that had missed earnings, and as a result, their stock got punished for it. And that's something that we haven't really seen a lot of, because in the past, if they missed earnings, they might drop 2, 3, 4, 5% in a day, not 10, 15% in a day. So there's a lot more volatility that we're seeing in stocks right now. So I do have some concerns about the stocks in general. For most all of 2023, the stock market growth was basically seven stocks: Amazon, Netflix, Nvidia, Microsoft, Apple, Tesla. So those seven stocks kind of drove the whole S&P 500, the stock market, higher. So that's kind of a risky environment to put stocks into, because if you're not in those seven stocks, the rest of the stock market, the other 493 stocks in the S&P 500 were basically flat. In some cases, were down, and so the average if you take those seven stocks out, I think the other 493 stocks were up. I think it was 2.9% or 2.8% last year. So now, as we enter 2024, we're seeing a broadening. We're seeing more stocks that are starting to show some signs of improvement. We still have areas of weakness. Those seven stocks, what was called the Magnificent Seven back in 23, those stocks are actually starting to weaken, quite a bit. In fact, Google, I was looking at that earlier. It's down 2.5% today. It's getting close to where it started the year at. And so there are stocks out there that are technology oriented that are coming down. And so the buy the dip mentality has kind of been what we've been seeing over the course of the last 6 months to 8 months in stocks. Stock market goes down. The people, like for instance, last Friday we were down 600 points. Today we're up 484. As far as the Dow is concerned, the Nasdaq was down almost 400. Over 400 points. It's up 193. So, we're seeing, as these stocks get punished, we are seeing people coming in and buying those dips, but the buy the dip mentality is not as strong as it was in 2023. So I'm hesitant to just say, okay, hey, the stock market goes down, let's buy the dip, because you can't necessarily do that with across the board. And at some point in time, we're going to have a situation where that's going to not work out. And I think we're getting very close to that because, again, if we enter in a recessionary environment, if things start to deteriorate rather quickly, that's going to cause a lot of problems for stocks. And so, I would the game plan for us going forward is we're going to have, having had conversations with some people, a lot of our clients who are risk oriented, who want to try and take advantage of that. We're going to try and be very um, cautious and going in and buying those stocks. We're going to go in and we are going to go in and try and buy some dips on some of these companies if you are a risk-oriented investor. And so we are planning to do that. That is a game plan for the risk-oriented investor. For the people who are retired or who are maybe not as risk-oriented, we're going to try and be very, very selective and kind of take a wait and see approach to where, let's just kind of wait and see if this, as we're entering September and October, these are historically the two roughest months for the stock market. In fact, October is when we've had a majority of our big blowups as far as the stock market is concerned, and September has not been very good either. So we're entering a seasonality problem as far as stocks are concerned. Earnings are not as strong as they have been in the past. There's a concern about a recession. So as a result, a lot of the uncertainty that's in the stock market right now is going to probably continue going forward. And if you're risk averse and you don't want to take a lot of risk, we're going to probably err more on the cautious side. Okay. So let me back up. Over the course of the next 3 months, our objective is to sit down and have review meetings with all of you. That's the game plan. Obviously, as your schedule permits. But our objective is to try and sit down and make sure that we all are on the same game plan. Because I think as we enter periods like now, and if we do run into a recessionary environment, or if we have an election situation that comes up that causes a lot of concern about the U.S. Constitution going forward, then that could cause problems for stocks as well. So I don't think now is the time to put the pedal to the metal and go all in on stocks. But for those of you who are risk oriented and who want to get high, have higher risk tolerance, we're going to be gradually picking off some companies and some names and adding positions to the stocks that you already have as they go down. But it may not be we're buying every dip. Okay. And again, for those of you who are risk averse, we're going to be very cautious going into this, and we're going to probably wait for a little bit of time to pass before we make any changes as far as entering the stock market. The money market rates are still over 5%. So if you're not in stocks, you're still getting a good 5% rate of return on your stocks. The bonds are still paying pretty good rates as well. So we're still making money on the cash or the uninvested, the money that's not in the stock market, but it's not, so we're still making good money there. So it's not like we have to jump out and say, okay, we're going to get it, time to move out of stocks because money market is only paying, 0.75% like it was a couple of years ago. We're in a position now where sitting in cash is actually very profitable for a lot of you. And so that's why we're going to continue to do that, especially if you're risk averse. All right. If for some reason, again, we're going to have conversations with all of you over the coming weeks. Again, that's going to be part of our conversation is say, okay, are we invested correctly? Should we be taking on more risk? Do we need to take on this much risk at all? I mean, there's some situations where, you know, um, you may have enough money to live off of the rest of your life. You'll never outlive your money. So why take the risk? There may be situations like that, but again, we'll have those conversations with each and every one of you, as that happens and as that occurs. All right. So I didn't want to say that. As the Fed starts to meet and as the Fed starts to roll over and drop interest rates gradually over time, that's going to cause interest rates on bonds to gradually cut over time as well. Short-term CDs, same thing. So when the Fed cuts rates, the Fed rate cuts affect the short end of the curve, basically where 0 to 3 months in length. So you'll start to see these CDs that are being advertised at the credit unions and some of the banks, the bonus 5.5 or 6% or whatever CDs, they're going to start going away as the Fed cuts rates, because as the Fed cuts rates, that's going to impact the banks and the credit unions on the short end of the curve in the short maturity levels, and so they're not going to be offering out a 3-month CD, a 6-month CD, a 1-year CD at the 5 and 6% rates like they are right now. And that's why these, by the way, that's why these all these CD offers that you see from your credit union and bank, that's why they're less than a year in length because they know, if rates start to head lower, they're not going to want to have, they don't want to have to owe you 6% on your money when they're only making 3% on their other loans, as rates have gone down. So as interest rates go down, we're going to start to see interest rates on bonds and fixed income go down. Eventually, there will be a lag, but eventually that money market rate at over 5% is eventually going to start to go down. Again, there's a lag. So the Fed starts cutting rates this month. The money market rates may take 2 or 3 or 4 months to start reducing, but there will, if the Fed continues to cut rates like they're expected to do, the money market rates are going to gradually come down as well. But again, there's probably a 3-month lag over, how quickly they're going to go down after the Fed starts cutting. So we will keep an eye on that. We'll monitor the situation as far as interest rates are concerned on the money market funds. But in the meantime, we are going to, for those of you who are fixed income oriented, we are going to make sure that we have a full investment in our bonds right now. Because if we can lock in rates now, at a 4% or 4.5% level or a 5% level for 3 or 4 or 5 years, you're locked in at that 4 or 5% level. If rates start to go lower, then you're going to be locked in, and that's not going to impact you at all. So that's why we want to try and lock in. If we think rates are going to go lower, the idea is to lock in rates now at today's levels before they go lower. And that's why we're going to make sure that our bond exposure or our bond allocations are fully met for those of you who are on a fixed income and who are drawing money off of your savings to help supplement your living. We're going to try and make sure that the interest rates that we receive are still going to be fairly high. And that by doing so, in order to do so, that would entail us having to put money into bonds now. And that's exactly what, the game plan is going forward. So I did want to just kind of, again, update you on kind of what we're seeing. I do think the economy is starting to slow down. I think stocks are going to get more volatile from here. I don't think that we're necessarily, time to put the pedal to the metal and put all of our money in stocks right now. I think there's still considerable risk out there associated with doing so. But those of you who, again, if you're risk oriented and when we have the Riskalyze come back to us and that confirms that you're risk oriented, then we'll definitely be looking for stocks to buy at good prices. Okay. I don't think we're going to buy every dip. If you check your account every day and you say, God, why didn't you buy more of that stock? That's why. Okay. So that's kind of the game plan going forward. As far as bonds are concerned, again, we're going to try and lock in at today's rates because we do think rates are going to start heading lower over the next 12 months to 18 months. So we're going to lock in, start making sure that as the bonds mature, we want to keep reinvesting those bonds back into more bonds so we can lock in today's rates before the interest rates fall over the next 12 or 18 months. Okay. So with that in mind, I just wanted to touch base and make sure that we communicate with you kind of what we're trying to do in terms of our investments and what we're starting to see. And with that, as I said before, we're going to be sending you Riskalyze assessments, questionnaires. If you could please just take 5 minutes to fill it out. It's greatly helpful to us in making sure that we're invested correctly. And then at the same time, there's more things coming out as far as services we're going to offer, more educational events, more educational videos that you'll have that you can watch at your own convenience, and just try and give you a little bit more education, a little bit more, more value for what, to provide more value to you guys. So, was there any questions out there?
Dave, if we lock in on our bonds, say at 5%, and Trump gets in office and things start going higher, can we get out of that that 5% and go higher?
Okay, so um, interest rates. So let me. So the interest. In answer to your question, yes, you could. If bonds go higher, we wouldn't be getting out the same amount that we put in. Okay, so but then that back it up. If Trump gets elected, bonds not interest rates may not necessarily go higher. Okay, because the basically his platform is less government spending, less dollars in the economy, and that's not inflationary. The only reason interest rates would go up is to offset inflation. And so what he's proposing is less government involvement and less government spending, and that's going
Mhm.
to be less inflationary, and that means the rates won't be going up. They'll probably be staying the same, if not going lower. So,
Okay.
so that's a good question. Thank you for, yeah, thank you. Um,
Okay.
so, so I have now that So thanks for the question. And again, going forward, we're going to be doing more of these, and we're going to be having more interaction with you in terms of not only interaction like this, two-way interaction, but we'll have one-way interaction. We'll be sending out more videos, more educational things. We're going to have, again, please fill out the Riskalyze questionnaire. That's at the fifth time I've mentioned it today. We really would like your help with that. We're going to be doing more financial planning. If you have, and again, we'll do free of charge. If you have kids, grandkids, other relatives that you think need help planning for college, for retirement, for whatever, we extend that offer of retirement planning to not only you as our client, but also as to your friends and family as well, to help. We're a service industry. We want to help everybody as much as we can, and so if we have the ability to help, that's what we're here for. And so we will. I would like to extend out to everybody an invitation, again, to utilize us for financial planning and other financial advice for your friends and family as well. So, again, that's. I appreciate your time, and we'll talk soon. All right. Thank you. Bye
Thank you,
bye.
Dave.
Thank you. Bye bye.